Trump officials suggest an interim trade deal may be possible and global markets like it. US-China trade wars have dominated headlines over the last month. However, rather than being bad news, we're seeing increasing signs of optimism that some sort of trade deal may indeed be possible. News that the US and China had agreed to low-level talks late September and high-level talks early October started to filter through the week before last. This week saw China announce a range of US goods would be exempted from the 25% extra tariffs put in place last year, seeking to ease the impact from the trade war. Newswires also suggested that China is expected to agree to buy more American agricultural products in hopes of a better trade deal with the United States, and Trump announced on Twitter this week that the US was delaying the planned tariff increase from 25% to 30% for 2 weeks to the 15th of October as a goodwill gesture. This notable thawing in relations between the US and China was a factor helping global equity markets surge higher through the week. The S&P 500 is within a whisker of the all-time high and up close to 7% from the early August low. Another factor helping global market sentiment this week is the idea that central banks are gearing up for action, and the ECB certainly did not disappoint. The outgoing ECB President Draghi announced a smorgasbord of monetary stimulus, including a cut in the deposit rate by 10 basis points to minus 0.5%, the restart of asset purchase program at €20 billion per month, and that this will continue as long as necessary and to end shortly before the ECB starts raising rates. The ECB also announced it will continue reinvesting redemptions and coupons for an extended period of time and past the start of raising of rates. On top of this, they made the new series of quarterly targeted longer-term refinancing operations, or TLTRO, more attractive to banks and introduced a two-tier system for reserve remuneration in which part of banks' balance sheets of excess liquidity will be exempt from negative deposit facility rate, therefore mitigating the negative impact rate on bank balance sheets. While markets were arguably expecting to see larger asset purchases announced, we see this as a very important and aggressive package that sets the scene for Christine Lagarde to take over the reins at the ECB on the 1st of November. However, the package did not receive unanimous support. There was dissent on asset purchases from Germany, France, Netherlands and Austria. Also, the ECB cut its growth forecast for 2019 to just 1.1% and next year to just 1.2%. It also slashed its inflation forecast to 1.2% this year and 1% next year, emphasizing just how significant the challenges will be for Christine Lagarde. Now, the focus on central bank action will continue next week too, with the Federal Open Market Committee meeting Tuesday and Wednesday, and then both the Bank of Japan and Bank of England on Thursday too. The FOMC will of course dominate, and talk of a ceasefire on trade wars has seen a full Fed rate cut removed from market pricing over the next 12 months, and talk of the FOMC opting for 50 basis points completely evaporate. But a 25 basis point cut next week is fully expected, and key will be commitment to further rate cuts. Westpac expects rates to be cut in September, October and December this year, and then again in March and June of next year too. The positive backdrop to US-China trade negotiations and aggressive action from central banks has helped lift many risk-sensitive currencies, including the Australian dollar, and we're up close to 2% so far this month. We cannot rule out some further strength next week and a possible trade above 69 cents. However, the domestic picture painted through various data points has been less upbeat this last week. Starting with the NAB business survey, not only was there an absence of a bounce, but conditions and confidence slipped further in August and remain below average levels. Similarly, for the household sector, the Westpac Melbourne Institute Consumer Sentiment Survey lapsed back into slight negative territory again, down to 98.2 in September from 100 in August. Now, next week brings a number of important events here in Australia. The Reserve Bank of Australia minutes are released on Tuesday, and then August employment data is out on Thursday. Westpac's forecasting a 7,000 rise in jobs, which would not be enough to prevent the unemployment rate from rising to 5.3%, which is a 12-month high. These are all factors we'll talk about in next week's Markets Update.